In my personal trading, there's a few chart patterns that I personally consider the best for trading any market in the time frame. And it's not so much the actual chart pattern itself that I'm really interested in, but more what the pattern is telling me. And that's why I don't need a perfectly formed pattern, but I do have some rules as to how the pattern should form. I look for an easy way to identify a pattern by understanding what the pattern represented. Now, humans, we seek patterns, and oftentimes we can make something out of nothing. And by having rules on how it should look, that keeps me honest. And yeah, chart patterns, they've been around for decades, but that does not really mean there's anything mystic about them. I see on the internet too many times traders that are usually selling something, talking about a special pattern that they use with, quote, deadly accuracy. Really, there's nothing secret in the market. Everything that you're going to see is a twist on an old concept. And if you understand the concept, you're going to understand the pattern. And some believe that you need the pattern to fit a textbook definition. But I'm here to tell you that a pattern does not have to be perfectly formed to be useful in your trading. Because in trading, close is close enough, and seeking perfection is really just a fool's game. In fact, many patterns are just slight variations of another pattern, and you trade them the exact same way. Simply, you just need to know how to read the pattern. Now, chart patterns don't work. We've heard that, and that's usually said by people who tried and failed to use them. And the word work, it's pretty relative. For me, they work, and that they help me decide on taking a position, where to enter, and sometimes when to exit. Now, before getting into the chart patterns, I want to cover 3 things that you have to understand about price movement. And learning these things is actually going to aid you a lot in your chart analysis and when you're looking for a pattern that you can trade. And the first one is highs and lows. Now, markets trend, markets go in trading ranges, and to know what it's doing, you have to understand what a chart high and low is. So if there's one pattern that you have to understand, it is the highs and lows that are on a chart. So if we think of a trending structure, it's just an alternating series of highs and lows, as we see here. Markets moving up is going to have an alternate series of higher highs and higher lows. A market that's heading down is going to alternate with lower highs and lower lows. And a market that's making alternate moves between the first two, well, that's just simply a trading range. In fact, I tell you, as soon as the structure begins to change, I start to consider that a range could be forming. And why that's important, I'll cover that in a bit. And here, once the peak is not broken, so a new high is not put in, the trending pattern is actually broken. So you must start thinking of another scenario. Now, momentum style candlesticks. So another price move that you have to note is large bull or bear candlesticks. And depending on the trend of the market, these are going to tell a story, and you should listen to it. In an uptrend or a downtrend, the with trend move, we call that the impulse move. And with the impulse move, we want to see intention in that direction without falling into a run in price that's climatic. We don't want to see climatic moves. So after we see a pullback in price, we see buying step in with conviction. And when you see these types of candlesticks, at least in the short term, that shows intent or strength in the direction of price movement. Now, these are the kinds of setup legs that you have to see when you're considering a pullback in price as a trading opportunity. Now, low interest pullbacks. So after we see that strong move in the direction of the trend, price will either pause with a range or it's going to retrace part of that leg. But what's important is we don't want to see momentum against the trend, because when we see that, that can point to either a strong unloading of long positions or traders taking a short position. Now, what we don't mind seeing is that after a lazy pullback, some climactic type of price action, because that can point to the turning point of price back in the direction of the trend. Even better, when you see a shallow pullback with lack of conviction, that can make for great trading opportunities. These last two make up trend strength analysis, and they're a pretty important thing that you have to know if you really want to understand how your market's moving. So let's identify and read probably the best chart patterns. And let's be honest, there is no best. And the following patterns are generally what I look for. And there are a lot of patterns you can trade. There's a ton, but all of them in some form are going to depend on the 3 chart moves that we just talked about. So to identify the chart pattern in your analysis, you have to have a rules-based selection process. Now, because nothing's perfect, having a general idea while understanding what's behind the pattern, that is enough. But I also want you to remember that the outcome of these patterns can be classified as generally some reversal patterns. They could be simply consolidations. Will a continuation pattern turn into a reversal? So yeah, it's important to look at trading patterns with the mindset of this will probably happen, but this other thing could also happen. So let's keep that in the back of our mind. So let's take a look at reversal chart patterns. And to be honest, I don't try to pick tops or bottoms of a market, but being aware of a shift in sentiment is important. So the head and shoulder pattern, or the inverse head and shoulders. This one we hear about a lot, but what is it really? So in an uptrend, we use the term head and shoulders. A downtrend, we're going to use the word inverse head and shoulders. So you can see here in this inverse head and shoulders, the same thing that we talked about earlier about trend structure. The left shoulder is a lower low. We get a lower high that's put in. Then we see a lower low with that head. Then we get another high. The right shoulder is now higher than the head in the middle. Now, generally, traders are going to wait for the neckline break. That's what connects the 2 peaks. They're going to wait for that to break before they're trading. But when I see this pattern, I look for price rejection at the right shoulder, and I'm in the trade long before that neckline break. Now, it is advised that you consider volume when you're looking at this chart formation. Lighter volume into the head as well into the right shoulder is important. The left shoulder, that can see normal volume. But here's the kicker. If you're trading volume, well, it's impossible to have real volume in that because it's not a centralized exchange. So in that case, just consider reading the trend structure we talked about to see lack of conviction into those levels. So what is the head and shoulders really? It's just a break in the downtrending market structure as a high low, the right shoulder plots, and it's confirmed upon a new high or new lows for a standard head and shoulders. That's all it is. Double tops and bottoms, called the W and the M patterns. These are simple patterns. The name is accurate. Price is going to plot 2 tops or 2 bottoms in the same price zone. Now this is a double bottom. Just reverse it for a double top. So remember, these are price zones, so price does not have to be exact. So what do you see here? Well, the low at 1 is normal in a downtrend, right? Price rallies, it puts in a peak, and then falls to 0.2. That's pretty normal. But in this example, think about it. What's been violated? Our trending structure, our downtrending structure of lower highs and lower lows, right? So price has failed to make a lower low in a bearish market and puts the trend into question. And when price takes out the peak on a closing basis, we generally have a higher high, which means a possible uptrend is now forming. Now again, as with the head and shoulders, volume can make up the pattern, but be honest with you, I don't use volume in any of my trading choices. So can you see how easy this is to understand? If you refer back to what we talked about, how price moves, these 2 major reversal patterns that I look at takes those 3 things into account. Is the market putting in a trend structure? Is there momentum into or out of a move? Is there lazy price action at the turning points? See, there's no need to complicate it with 17 different questions or looking for pinpoint accuracy or just getting tied up with the volume. If you keep it simple, that goes a long way. And in fact, you might just use these to understand the possible next steps in the market and to tip you off on an important reversal in the market. All right, so let's get to top continuation patterns. And again, unlike our major reversal patterns, continuation patterns, they're going to happen a little bit more frequently. In fact, once you note the completion of a major chart pattern reversal, the first things we talked about, now you can gear up to look for continuation patterns. And because we're looking at a continuation, we want to take these trades in the direction of the overall trend. Okay, and that overall trend is dependent on your personal time frame. So as we cover these patterns, again, I want you to tie your understanding into the 3 price moves that we've talked about. Now, the first patterns I want to talk about are the different kinds of triangles: symmetrical, ascending, and descending. And we can draw these patterns using a trend line, and we need 4 points on the chart. So the symmetrical one, we want to assume in this here that the trend's up. So we need the pattern to essentially form in this manner. Number 1, our high is made in the direction of the trend. At 2, this is a retracement against the initial move. At 3, price is going to rise to test number 1, but it's going to fail to gain ground to the upside. We have another retrace in price that does not break the low at 2. So we're looking for 4 points. Okay, so the minimum amount of time to form this pattern is 4 periods. So whatever your time frame is, doesn't matter. Your entry is going to be a break of the line that's made between 1 and 3. Put your stop under 0.4, or depending on you as a trader, you can put it under 0.2 for a more conservative stop. I actually prefer this triangle chart pattern to be tight, and I don't really want it to exceed more than 15 periods. Ideally, in a perfect world, it's going to take 4 to 6 periods, and I find those triangle trades a little bit more reliable. Now, keeping it simple, can you see the highs and lows as we just talked about? We have here in this example lower highs, higher lows, which is a consolidation. So in truth, I call all of these patterns consolidation patterns because that's exactly what price is doing. This chart carries the pattern of 4 points. And again, these are going to take different forms, okay? The key is to keep it simple. And the question is price consolidating? Yes, okay. Well, then where's the entry? Where's the stop? Simple. The ascending triangle. We're going to look at an uptrend here, obviously, ascending. So the idea with this pattern is we're going to see static highs, a resistance zone, okay? We're going to see rising lows, which are resistant levels. It's going to show constant buying at the higher prices, with the selling pressure weakening, right? Low interest pullbacks. So break of resistance here, that's the entry zone. And this pattern, again, can take different forms. We can see basing just under resistance on the last leg up. And traders with an understanding of springs are going to find an entry earlier than the breakout. A descending, it's just the opposite of the ascending. And we often see this in a downtrending market. The entry, everything else, the exact same as the prior triangle, but we're just looking to the downside. Bull and bear flags. This is just a triangle formation that has the number 4 low in an uptrend lower than the number 2 low. So listen, think of this as a downtrending structure, okay? Remember our highs and low, how they move. That fails back in the direction of the underlying trend. Entries and the stop loss virtually the same as the triangle. Want to see a break of the upper line and a stop loss below the last swing low. Horizontal consolidations. Now, this is the last pattern I look for, and it's just a simple horizontal consolidation along with a test of highs or lows. And in this example, I want you to think that we're in an uptrend. And you can see that price just makes relatively equal highs and lows. And that takes away our requirement of higher highs and lows for an uptrend, right? So we don't see that. We're looking at consolidation. So what I look for in this is a break below support in an uptrend, okay? That's called a spring. And I look for a quick buyback into the range. This is actually an entry with a defined stop loss, which is just under the low. And in a perfect world, price rises to the resistance after a small base, it breaks out. But what can happen is the momentum on the breakout is so strong when you're already in the trade that you gain much in the way of profits as soon as it breaks out. Okay, so let's finalize this here. So if you understand the 3 price movements that we talked about, you can basically decipher any chart pattern that's out there. Now, that does not mean that they're easy to trade. Okay, it also doesn't mean that they're going to succeed. But what it does do is it give you a rules-based approach to price patterns. That's pretty much becoming a lost art for many traders. So think about it. Trending price action has a high and low series depending on the trend. Okay. When the pattern begins to change, we may start to see a consolidation taking place on one of the patterns that we just talked about. And then we can use a weak or strong price movement as a measure of sentiment, which is the way the market wants to go. Now, technical indicators, of course, they have their place in trading. You can use indicators for trend, oversold, overbought, divergence trading. That's a good use of them. Use the same indicators with chart patterns, especially the top patterns I just talked about. I think it can go a long way in you personally finding success in